Welcome to the Deep Dive, the show where we cut through the noise and get straight to the insights you need to be truly well-informed.
Glad to be here.
Today, we're taking a strategic plunge into a document that, honestly, can unlock some significant financial opportunities for every self-employed individual and small business owner. We're talking about Schedule C, Form 1040.
That profit and loss statement.
Exactly. We've meticulously reviewed the latest 2024 instructions. It's dense, I won't lie, but incredibly valuable to help you navigate this crucial tax form with, well, more confidence.
Yeah, definitely.
Our mission today isn't just to explain the mechanics, fill in box A, box B. It's really to pinpoint the very best strategies and those often overlooked deductions that can lead to significant tax savings.
Putting more of your hard-earned money back in your pocket, not Uncle Sam's.
That's the goal.
That's right. For many, Schedule C can feel like just another, daunting pile of paperwork. But what's truly powerful here is that it's your business's financial narrative for the IRS.
Right, it tells the story.
It really does. It's a roadmap to understanding your profitability and, like you said, discovering some really powerful tax advantages. We're going to walk you through it, focusing on how each piece of information can translate into real, tangible savings for your business.
Okay, let's unpack this then. Lay the groundwork first. The fundamental question: what exactly is Schedule C and who absolutely needs to file it?
At its core, Schedule C is designed to report income or loss from a business you operate or profession you practice as a sole proprietor.
So the classic freelancer, the side hustle, the small shop owner.
Exactly. It's essentially your business's profit and loss statement for tax purposes. If you're running a side gig, a freelance operation, or a full-fledged small business without, say, formal incorporation, this form is very likely for you.
Okay.
And it's actually broader than just those traditional sole proprietorships. It also covers wages and expenses for what the IRS calls statutory employees.
Statutory employees. Okay, tell me more about that.
Yeah, these are specific types of workers like full-time life insurance agents or certain traveling salespersons. They're treated as employees for Social Security and Medicare tax purposes, but they uniquely file Schedule C to report their income and deduct their expenses.
Interesting distinction.
It is. You'll also use Schedule C for income and deductions from certain qualified joint ventures. We'll definitely get into those later. They're quite useful for married couples. And, of course, for amounts reported on various 1099s.
Ah, the 1099s. Everyone gets those.
Pretty much, yeah. Specifically, we're talking 1099 MISC for miscellaneous income, 1099 NEC for non-employee compensation, that's the big one for contractors, and 1099K for payment card and third-party network transactions, like from PayPal or Stripe.
Right, the platform payments.
Exactly. So if you're receiving income through any of these channels, whether you're a gig worker, a consultant, maybe a service provider, Schedule C is almost certainly in your future.
Okay, now here's a really crucial distinction, and you said it earlier. This is like your very first foundational tax-saving filter. The difference between a business and a hobby.
The IRS is very clear on this point.
They care about this, don't they?
Oh, they definitely care.
Yeah.
An activity qualifies as a bona fide business if your primary purpose for engaging in it is to make income or profit. And, importantly, you're involved with continuity and regularity.
Continuity and regularity, okay.
This isn't just some, legalistic detail. It's central to your ability to claim deductions. It's fundamental.
So why does this distinction matter so much for taxes?
It matters immensely because your ability to deduct expenses is tied directly to whether the IRS classifies your activity as a business. If your activity is sporadic, maybe it's primarily for enjoyment, or it just doesn't demonstrate a genuine intent to make a profit.
Like my artisanal birdhouse building that loses money every year.
Right, exactly. The IRS would likely classify that as a hobby. And if it's a hobby, your expense deductions are severely limited.
How limited?
Well, hobby income still needs to be reported, yes. But those expenses are reported differently, like on Schedule 1, Line HA. And crucially, they can only be deducted up to the amount of income the hobby generates.
Oh, so you can't create a loss with a hobby.
Exactly. You can only zero out the income, but even then, only if you itemize your deductions on Schedule A. So if you take the standard deduction, you might not get any deduction for hobby expenses.
Wow, okay, that's a huge difference.
It is. Understanding this upfront is absolutely vital for maximizing your deductions and, frankly, for avoiding unwanted attention from the IRS. You need to ask yourself, are you treating this like a serious venture with a profit motive, or is it genuinely just a pastime? That self-reflection really sets your tax strategy from the get-go.
That's a critical question to ask right from the start. Okay, let's pivot then to what's new for 2024 and some essential reminders. The IRS, they constantly update rules, and understanding these changes can directly impact your tax strategy. What stands out for 2024?
Well, one notable administrative change, it might not affect everyone, but it's for Form 1040 SS filers. These are often individuals in U.S. territories.
Okay.
For 2024, if you're one of these taxpayers claiming a deduction for the business use of your home, you'll now report that expense directly on Schedule C, line 30. You'll often calculate it using Form 8829, the Home Office form.
So just streamlining it for those filers.
Exactly. It helps simplify reporting for certain taxpayers who might have navigated a, let's say, more complex process before.
Got it. And a perpetually important piece of information, especially for anyone driving for business, the standard mileage rate. What's the number for 2024?
For 2024, it's set at 67 cents per mile.
67 cents.
Yep. And this offers a really simple way for many business owners, particularly those who drive a lot for work, to calculate a significant deduction without the headache of tracking every single receipt for gas, oil changes, maintenance, all that stuff.
It really is the easy button sometimes for vehicle expenses, isn't it?
It absolutely is. It's a simplification many appreciate for its straightforwardness. Now, another important update, though it's technically a phasing out, is for bonus depreciation.
Bonus depreciation, always a hot topic.
Always. This deduction lets you accelerate the write-off of certain new or used business assets. Basically, you claim a large portion of the costs in the year you buy them rather than spreading it out over many years.
Which is great for lowering current year taxes.
Absolutely. In 2024, the bonus depreciation percentage is reduced. It's down from 80% to 60%.
Still 60%, though. That's significant.
It is. While it's phasing down, it still offers a powerful way to deduct a substantial chunk of qualifying asset costs immediately. This can significantly lower your taxable income in the year you place those assets in service. Think of it as a strategic tool to kind of front-load your deductions.
Good to know. Okay, speaking of important reminders, let's quickly touch on business meals. The general rule still applies, right?
Yes, the general rule still applies. Most business meals are 50% deductible.
50%. Got it.
We'll definitely unpack some specific and maybe surprising exceptions to that rule later, but it's important to remember that baseline, that 50% for your day-to-day business dining.
Okay. Now, you mentioned something earlier that sounded really interesting, especially for certain service providers. Something about Medicaid waiver payments.
Yes. Here's where it gets really interesting and potentially very valuable for specific service providers, particularly those in the home care sector. We're talking about non-taxable Medicaid waiver payments.
Okay.
These payments, often received by caregivers providing in-home supportive services, may actually be non-taxable under specific IRS guidance. Specifically, notice 2014-7.
Non-taxable, so tax-free income.
Potentially, yes, but here's the critical detail, the part you cannot miss. You must still report these payments as income on Schedule C, line 1.
Okay, so it goes on the income line first.
Yes. Then you immediately report the exact same amount as an expense down in Part V, other expenses, line 48, and you need to add a specific notation next to it. Notice 2014-7.
So it nets to zero. Income in, expense out.
Precisely. This isn't just about reporting. It's a direct tax exclusion that requires very specific handling to ensure you don't mistakenly pay tax on income that isn't truly taxable. For someone receiving these payments, this can translate to thousands of dollars in tax savings.
Wow.
It turns what looks like income into basically a zero-sum game for tax purposes. It's a significant tax-saving detail, easily overlooked, but the impact can be immense.
That is a fantastic, nuanced insight. That could save a specific group of our listeners a lot of money. And for anyone earning income from on-demand work, the gig economy, the IRS has resources, right?
They do. They have a dedicated resource center at irs.gov/gig. It's a really valuable starting point for understanding your unique tax obligations and, just as importantly, potential opportunities for deductions in that whole gig space.
Good resource. Now, a critical reminder for those who might be looking at a loss on Schedule C this year. If line 31 shows a loss, there's something called the excess business loss limitation.
Yes, that's right. This rule, which you figure out using Form 461, means that if your business loss exceeds certain thresholds for 2024, that's $289,000 for single filers or $578,000 for married filing, jointly, the excess loss, the amount over that threshold, is disallowed for this year.
Disallowed, so you just lose that deduction.
No, not permanently. That's the key. The disallowed amount doesn't just disappear. Instead, it's treated as a net operating loss, an NOL, and it carries forward to be deducted in a subsequent year.
Okay, so it benefits you later.
Exactly.
Oh.
While it might not give you an immediate deduction this year, it essentially creates a credit against future tax liability. It's crucial for multi-year tax planning and maintaining your long-term financial health. You don't lose the deduction entirely, it just gets delayed.
It's all about playing the long game, understanding how current year losses can maybe benefit you down the road.
Okay, now let's talk about the ecosystem of related forms and business structures you might encounter. Schedule C doesn't really live in a vacuum, does it? Not at all. Beyond Schedule C itself, you might also need Schedule SE. That's for calculating your self-employment tax, Social Security, and Medicare on your business income.
Right. The self-employment taxes, can't forget those.
Definitely not. If you're acquiring new assets for your business, like equipment or vehicles, Form 4.562 is essential. That's for claiming depreciation and amortization. And it's especially important if you're leveraging that powerful Section 179 extents election to deduct the cost of certain property all in one year.
We'll dive deeper into Section 179 later, I assume.
Oh, absolutely. It's a big one for savings. For those who use their home for business, Form 8829 is the form for claiming actual home office expenses, which is an alternative to the simplified method we'll also discuss.
Okay.
And perhaps most significantly for overall tax reduction, don't forget Forms 89995 or 89995A. These are for claiming the qualified business income deduction, the QBI deduction.
The QBI deduction, that can be a big one too, right? Up to 20%.
Potentially, yes. It can significantly reduce your overall tax liability on your personal return, Form 1040. It's a major benefit tied to your Schedule C income.
Got it. So many interconnected forms. Now, many entrepreneurs start out with a single-member LLC. It's popular for liability protection. How does that structure fit into Schedule C for tax purposes?
Right. LLCs are very common. Generally, a single-member domestic LLC isn't treated as a separate entity for federal income tax purposes by default.
So the IRS just ignores the LLC part for income tax.
Pretty much.
Right.
If you're the sole member, the IRS considers it a disregarded entity. This means you typically report your business activity directly on Schedule C, or Schedule E for rentals, or F for farming, just as if you were a sole proprietor.
Okay, simple enough. Any exceptions?
The main exception is if you've affirmatively elected to treat the LLC as a corporation. That requires filing Form 8832. It's called the check-the-box election. But most single-member LLCs don't do that. Now, even if your single-member LLC isn't a separate tax entity for income tax, if it has employees, it must still file employment tax returns using the LLC's own employer identification number, EIN, and name, not your personal Social Security number. That's an important distinction for payroll.
Good point. Now, you mentioned qualified joint ventures, QJVs, earlier. You said they could simplify things for married couples who jointly own an unincorporated business. Tell us more about the simplification strategy.
Yeah, it's really a strategic gem from the IRS for married couples. This election allows a married couple who jointly own and operate an unincorporated business, one that would otherwise technically be a partnership, to avoid the complexity of filing Form 1065, which is a full partnership return.
And partnership returns can be complicated.
It definitely can be. Instead, with the QJV election, each spouse can elect to file a separate Schedule C or Schedule F for farming, reporting their share of the income and deductions.
Okay, what are the requirements to do that?
The key requirements are, first, each spouse must materially participate in the business. We'll define material participation later. Second, you must be the only owners of the business. And third, you must file a joint tax return.
Makes sense. What's the big benefit besides avoiding the partnership form?
The beauty of this, beyond simplifying the tax filing, is that it ensures each spouse gets credit for Social Security earnings based on their share of the profit. This can significantly impact individual eligibility for retirement, disability, and Medicare benefits down the line.
That's huge for long-term planning.
It really is.
Yeah.
And in most cases, electing QJV status won't even increase your total tax owed. It often offers a true win-win for couples who run a business together.
So a significant benefit with minimal downside. But you mentioned a limitation earlier, something about LLCs.
Yes, that's an important caveat. This QJV election doesn't apply to businesses owned through an LLC or any other state law entity like a partnership or corporation.
Okay, so it has to be directly owned by the spouses.
Exactly. It's specifically for businesses owned and operated by spouses as co-owners directly, without the buffer of a separate legal entity. And, just to clarify, electing QJV status for, say, a rental real estate business doesn't automatically change how things like self-employment tax or passive loss rules apply to that activity. You still need to consider those rules separately.
Got it. And for our listeners in community income states, places like California, Texas, Arizona, etc., where income and deductions might be split between spouses, even if only one participates, how does that work with Schedule C?
Right. Community property states add another layer. In those states, if you and your spouse wholly own an unincorporated business as community property, you generally have a couple of options.
Okay.
You can elect to treat it as a sole proprietorship.
Yeah.
In that case, all the income and deductions are reported on a single Schedule C by the spouse who primarily operated or managed the business. If only one spouse materially participates, all the income is considered that spouse's self-employment earnings for SE tax.
And if both participate?
If both spouses materially participate, it's generally treated as a partnership by default under community property rules. Income and deductions would be allocated based on their distributive shares. However, in this scenario, they could then make the qualified joint venture election we just discussed, allowing each to file a separate Schedule C.
So they still have that QJV option even in community property states if both participate?
Correct, if they meet the QJV requirements.
Yeah.
The important thing is to understand your specific state's community property laws and how they interact with your business structure and participation levels to ensure you're reporting everything accurately.
Okay, good advice. Shifting gears slightly, let's talk about information returns, specifically Forms 1099. There's been a big change here recently that impacts a lot of small businesses, right? The e-filing threshold.
Yes, this is a huge compliance point, a change that really crept up on a lot of folks. The mandatory electronic filing threshold for information returns, things like Form 1099 NEC for payments to non-employees, 1099 MISE, 1099 INT for interest, 1099 DIV for dividends, etc., has been drastically lowered.
Lowered from what to what?
It went from 250 returns of any one type down to just 10 returns, aggregated across all types of information returns combined.
Wow, only 10. That catches almost everyone who hires a contractor or two.
Exactly. This is effective for forms required to be filed after December 31st, 2023. So for the 2024 tax year forms you'll file in early 2025, this 10 return threshold applies. It means many, many more businesses will now be required to e-file these forms, moving away from paper filing.
And penalties for not e-filing if required.
Yes. Failure to e-file when required can lead to penalties, and they can be significant depending on how late you are and how many forms are involved. So it's absolutely crucial to be aware of this new, much lower threshold and plan your filing method accordingly. It's a subtle change with really broad implications for small business compliance.
Definitely something to flag. And finally, before we dive into the form itself, a quick mention about the reportable transaction disclosure statement, Form 8886. Why is this important for our listeners to be aware of?
This form, Form 8886, is critical for avoiding potentially substantial penalties. If you've participated in certain types of transactions that the IRS deems reportable, these often involve specific tax avoidance strategies or transactions resulting in significant losses.
Like how significant?
For instance, a loss under Section 165 of at least $2 million in any single tax year, or $4 million over a 6-year period for individuals or Schedule C filers. There are other categories, too, like confidential transactions or transactions with contractual protection. If you're involved in something like that, you must file Form 8886.
And the purpose is?
It's all about transparency with the IRS regarding complex or potentially aggressive tax positions. The IRS uses this form to identify transactions that they might want to scrutinize more closely, transactions they deem potentially abusive. Failing to disclose these reportable transactions can lead to really substantial penalties and interest, making it a crucial compliance step for any business engaging in such activities. Most small businesses won't run into this, but if you do complex deals, be aware.
Good to know. Okay, now that we've laid all that foundational understanding, the purpose, the related forms, the recent changes, let's move into the top section of Schedule C itself. The basic business information, lines A through I. These might seem like simple boxes to fill, but they set the stage, right? They give the IRS a snapshot of your operations.
That's exactly right. And precision here is important, even in these basic details. Line A asks for your principal business or profession, including product or service.
So be specific.
Be reasonably specific, yes. You need to provide a general field or activity, and then the specific type of product or service you offer. For example, don't just put consulting. Maybe put management consulting services or IT consulting for small businesses.
Okay.
Or instead of just retail, something like online retail sale of handmade jewelry or wholesale sale of hardware to retailers. Clear and concise is the goal.
And if you're one of those multi-talented entrepreneurs running, say, a consulting business and an unrelated Etsy shop.
Good point. It's really important to remember that if you have more than one distinct business, each business requires its own separate Schedule C. You cannot combine them onto a single form.
Each distinct venture needs its own tax story told.
Perfectly put. Each needs its own Schedule C.
Okay, line B is the principal business or professional activity code. That sounds official.
It is, but it's straightforward to find. It's commonly known as the NAICS code North American Industry Classification System. It's a 6-digit code that classifies your sole proprietorship within the broader economy.
How do you find the right code?
The instructions for Schedule C have a comprehensive list at the very end. You typically select the broad category first, like, say, professional, scientific, and technical services, and then you narrow it down to your specific activity, maybe accounting, tax preparation, bookkeeping, to find the precise code, like 541219.
And why does the IRS want this code?
It helps them understand your industry and, frankly, benchmark your reported income and deductions against similar businesses. It's part of their data analysis.
Makes sense. Okay, line D asks for your employer identification number, or EIN. When do you actually need to put an EIN here, and when can you just leave it blank and use your social security number?
Right. You only need an EIN on Schedule C if you meet specific criteria. You need one if you have a qualified retirement plan for your business, like a KEO or solo 401k.
Okay.
Or if you're required to file employment tax returns, like Form 941 for employees, or excise tax returns, or specific returns related to alcohol, tobacco, or firearms. Also, if you're a payer of gambling winnings, you'd need an EIN.
So for most simple sole proprietors with no employees or retirement plan.
For most simple sole proprietors, you should leave line D blank and just use your Social Security number for filing the Schedule C itself.
What about those single-member LLCs we talked about, if the LLC has an EIN?
Good question. If the single-member LLC has its own EIN, perhaps for reasons like having a retirement plan or needing to file employment tax returns for employees, then that LLC EIN goes here on line D.
Not your personal SSN.
Correct, the LLC's EIN in that specific case. What's absolutely critical is not to put another taxpayer's EIN here, like one from a 1099 MISC you received from a client. That's a common mistake. This box is only for your EIN if you have one and are required to use it for Schedule C.
Got it. Line E, business address. Straightforward.
Pretty much. A standard street address, not a P.O. box unless that's your only mailing address. However, here's a helpful little tip. If your business is conducted solely from your home, and that home address is the exact same one you put on page 1 of your Form 1040 tax return,
Yeah.
you actually don't have to complete this line E.
Oh, really? Saves a bit of writing.
A small detail, but it can save a moment, yeah.
Okay. Line F, accounting method. This sounds important. Cash or accrual?
It is a fundamental choice, yes. It has significant implications for how you report income and expenses throughout the year. You can generally use the cash method, an accrual method, or sometimes another special method if permitted.
What's the basic difference between cash and accrual?
In simple terms, the cash method means you generally report income in the year you receive it, actually or constructively, and deduct expenses in the year you pay them.
Okay, cash in hand, cash out.
Pretty much. The accrual method means you generally report income in the year you earn it, even if you haven't received the cash yet, and you deduct expenses in the year you incur them, regardless of when you actually pay.
So, based on when the obligation arises, not the cash flow.
Exactly. Now, the method you choose must clearly reflect your income. And here's where it gets really advantageous for many small business owners, that small business taxpayer exception we touched on earlier.
Right, the $30 million threshold.
Exactly. If your average annual gross receipts are $30 million or less for the 3 prior tax years, and you're not considered a tax shelter, you generally are not required to use the accrual method, even if you have inventory.
That seems like a huge simplification.
It's a major simplification and a significant cash flow benefit. It means many small businesses with inventory can still use the simpler cash method. This allows you to often deduct expenses when they're actually paid rather than when incurred, and recognize income only when it's received, not when it's just billed.
Which is great for managing cash flow day to day.
Absolutely.
Yeah.
It can significantly improve your cash flow by potentially delaying the recognition of income and accelerating expense deductions. And it simplifies your record keeping immensely compared to accrual. It's a very practical saver for small businesses focused on managing their money.
That is a huge relief for many entrepreneurs. What if you're already established using one method, say accrual, and now you qualify for cash and want to switch? Can you just switch?
Not quite that easily. Changing your accounting method generally requires getting IRS consent, which usually means filing Form 3115, Application for Change in Accounting Method.
Form 3115 sounds complex.
It can be quite involved, yes, it's not a simple form, and when you make this change, you might also have to make what's called the Section 481A adjustment.
A Section 481A adjustment. What's that?
Think of this adjustment as the IRS ensuring that amounts of income or expense aren't accidentally duplicated or omitted simply because you changed your accounting method.
Ah, like a true-up calculation.
Exactly. For example, if you switch from accrual to cash and you received payment in 2024 for a sale that you already included in income back in 2023 under the accrual method, without an adjustment, you'd effectively report that income twice. The 481A adjustment prevents that.
Does it help or hurt your taxes in the year of change?
It depends. A net negative adjustment, which reduces your income, favorable for you, is typically taken all in the year of change. But a net positive adjustment, which increases your income, is usually spread over 4 years to mitigate the immediate tax hit. So changing methods can definitely impact your taxable income in the year of change and subsequent years. It's a decision to make carefully, maybe with professional advice.
Definitely sounds like something to plan for.
Uh-huh.
Okay, next up, line G, material participation. This is just a yes or no box, but you said earlier it has big implications, especially for losses.
Huge implications. Checking no here means the IRS considers the activity passive, and that can severely limit your ability to deduct any losses from this activity against your other active income, like wages from a job or profits from another business you do materially participate in.
So checking no could mean your loss gets stuck.
It could, yes. It raises that important question. If you have a loss, are your losses truly deductible right now, or are they limited? To qualify for material participation, generally, it means you were involved in the activity with continuity, regularity, and substance.
How is participation defined? Just showing up.
It's generally any work you did in connection with an activity you owned, regardless of your capacity. It could be management, operations, services, anything. However, certain things don't count.
Like what?
Work that isn't customarily done by an owner doesn't count if one of the main reasons you did it was to avoid the passive loss rules. Also, work done purely in your capacity as an investor, like just studying financial statements, preparing summaries, or monitoring operations in a non-managerial way, generally doesn't count towards material participation hours.
Okay. What about spouses, if my spouse helps out?
Good question. A helpful point is that work done by your spouse for the activity generally counts towards your material participation hours, even if your spouse doesn't own an interest in the business themselves and you don't file a joint return.
Well, that's useful for family businesses.
Definitely.
So how does the IRS actually measure material participation? Is there a specific hour count?
Yes, there are actually 7 tests, and you only need to meet one of them for the year to be considered materially participating.
7 tests. Okay, what are the main ones most people might meet?
For most active sole proprietors, the most common test, the easiest one usually, is simply if you participated in the activity for more than 500 hours during the tax year.
More than 500 hours. That's about 10 hours a week.
Right. If you're running the business full-time or even significantly part-time, you likely meet this. Another frequently met test is if your participation was substantially all the participation in the activity by all individuals for the year, including any employees or non-owners. If you're the only one doing the work, you meet this test.
Okay.
There's also one if you participate for more than 100 hours, and that's at least as much as any other person involved in the activity.
Makes sense. What if you have multiple side businesses?
There's a test for that too. If the activity is a significant participation activity, which generally means you participate for more than 100 hours but less than 500, and your total participation in all such significant participation activities for the year exceeded 500 hours combined, then you materially participate in each of those activities.
Okay, that covers people juggling multiple gigs. Any other common ones?
There are tests based on prior year participation too. Like if you materially participated for any 5 of the prior 10 tax years, or for personal service activities like health, law, accounting, arts, consulting, if you materially participated for any 3 prior tax years. And finally, there's a facts and circumstances test, but it's more complex and generally requires over 100 hours, plus regular, continuous, substantial involvement.
So several ways to qualify. What about rental activities? Are they always passive? Or oil and gas?
Generally, rental activities are considered passive activities by default, unless you qualify as a real estate professional under specific stringent rules or meet one of a few other exceptions. If an exception applies, then the material participation tests we just discussed come into play.
Okay.
For oil and gas, if you own a working interest directly or through an entity that doesn't limit your liability, like a general partnership, the activity is generally not considered passive, regardless of your participation level. That's a key distinction for investors in that area.
So the bottom line on line G.
The bottom line is, if you check no on line G because you conclude you don't materially participate, or if it's a rental activity that doesn't meet an exception, your losses may be limited by the passive activity loss rules. This generally requires you to file Form 8582, Passive Activity Loss Limitations.
And that form calculates how much loss you can actually deduct this year.
Exactly.
Yeah.
It's crucial because it means you might not get the full immediate benefit of your business loss this year, although the disallowed loss usually carries over to potentially offset passive income in future years.
Okay, definitely need to get line G right if you have a loss. Line H seems simple. Did you start or acquire this business in 2024?
Yep, straightforward checkbox. Just check it if this is the first year for the specific business activity for you, or if you reopened a business that was previously closed.
And finally, line I. Did you make any payments in 2024 that would require you to file Forms 1099?
Right. Check yes here if you made payments during the year that required you to file any type of Form 1099. The most common ones for Schedule C filers are 1099 NEC for payments of $600 or more to independent contractors, or 1099 MISC for things like rent payments of $600 or more.
And this connects back to the e-filing threshold change.
Exactly.
Yeah.
As we discussed, failure to file these required 1099s can lead to penalties, and that new e-file threshold of just 10 total returns means many more businesses will need to e-file these. So checking yes here is also a reminder to yourself about those compliance obligations. It's an area the IRS definitely watches.
Absolutely cannot overlook that. Okay, great. Now that we've covered the foundational details at the top of the form, let's move into part 1 of Schedule C Income Insights, lines 1 through 7. This is where you report all your business earnings, the top line of your profit calculation.
Exactly. Line 1, gross receipts or sales, is the bedrock. This is where you report the total gross receipts or sales from your trade or business. You must report all income.
All income, even cash.
Especially cash. All income means all income, whether paid by cash, check, credit card, barter, digital currency, whatever. A critical step here is to meticulously verify your reported income against any forms, 1099 NEC, 1099 MISC, or 1099K that you receive from clients or payment processors.
Why is reconciling those 1099s so important?
Because the IRS gets copies of those forms too. If the total amounts reported on the 1099s issued to you are more than the gross receipts you're reporting on line 1, the IRS computer system will automatically flag that discrepancy.
And that means?
That likely means a letter from the IRS asking for an explanation, or potentially an audit. If there's a legitimate reason for a difference, maybe a 1099 includes payments from a prior year you already reported, or includes personal items you need to attach a clear statement to your return explaining the discrepancy. Transparency here is absolutely key to avoiding unnecessary headaches.
Good advice. Reconcile those 1099s. Now, what about those statutory employees we mentioned earlier? They get a W-2 but file Schedule C. How does that work on line 1?
Right. If you're a statutory employee and you received a Form W-2 with the statutory employee box, checked in box 13, you specifically report the income from box 1 of that W-2 on Schedule C, line 1.
Okay.
And, very importantly, you must also check the dedicated box on line 1 of Schedule C that indicates you are a statutory employee. This tells the IRS why you're reporting W-2 income here.
And the benefit of that status again.
Since Social Security and Medicare taxes were already withheld from those statutory employee earnings, as shown on your W-2, you do not owe self-employment tax on this specific income. That's a significant advantage compared to regular self-employment income.
Okay. What if someone has both? Like, they drive for a company as a statutory employee, but also have their own separate freelance work.
Great question. If you have both regular self-employment income and statutory employee income, you absolutely must file 2 separate Schedule Cs. You cannot combine them. One Schedule C for your true self-employment business, and another one specifically for the statutory employee income, making sure to check that statutory employee box.
2 Schedule Cs. Got it. Now, a newer income stream for some, especially maybe college athletes or influencers. Name, image, likeness income, or NIL. How is that typically handled for tax purposes? Schedule C.
Generally, yes. NIL income, because it's usually paid for services like endorsements, appearances, social media posts without a formal employer-employee relationship, is typically considered independent contractor income.
So self-employment income.
Exactly, which means it should be reported on Schedule C and it's subject to self-employment tax. However, if the payment structure is explicitly set up as royalties for the ongoing use of your name or image, rather than for specific services, it might, in some rare cases, be reported on Schedule E, supplemental income and loss, instead.
Ah, okay. Schedule E is usually for royalties and rentals.
Right. It's important to understand the specific nature of those NIL contracts and payments to ensure correct reporting, but Schedule C is definitely the most common home for it.
Okay. And let's revisit that powerful hidden exclusion we talked about earlier, those non-taxable Medicaid waiver payments. Remind us how that works on the income side, line 1.
Yes, this is that crucial tax-saving detail again, specifically under Notice 2014-7. If you receive these specific types of Medicaid waiver payments, generally for caring for a disabled individual who lives in your home under a state program, even though they might be excludable from your gross income, you still must report the full amount you received as income on Schedule C, line 1.
Report it even if it's non-taxable. Seems counterintuitive.
It does, but it's required for proper reporting. You report the income first. Then, as we discussed, you take an offsetting deduction for the exact same non-taxable amount down in Part V, other expenses, line 48, noting Notice 2014-7.
So the income reporting on line 1 is just the first step in that two-step process to exclude it.
Precisely. It ensures the IRS sees the payment came in, but also sees that it's being correctly excluded based on their own guidance.
Yo.
Missing either step means you might incorrectly pay tax on it.
Very important detail for those specific providers. Okay, line 2 is for returns and allowances. This sounds like it reduces income, which is usually good.
Exactly. This is where you subtract amounts for sales returns like cash or credit refunds you gave to customers because they returned merchandise and sales allowances, which are reductions you gave in the selling price, maybe for minor defects or damages.
So if I sold something for $100, but gave a $10 discount for a scratch, that $10 allowance goes here.
Well, you'd report the net sale of $90 on line 1, typically. Line 2 is more for returns after the initial sale or allowances given later. You report the total returns and allowances as a positive number on line 2, and then you subtract it from line 1 to get your net receipts on line 3.
Ah, okay. So it directly reduces your gross receipts reported on line 1.
Correct. This isn't just about accounting accuracy. It's a fundamental way to lower your starting income figure. Subtract line 2 from line 1 to get line 3. Line 4 is cost of goods sold, which we'll get to later, and line 5 is gross profit.
Got it. Then we skip down to line 6, which is the catch-all for other business income. What kind of things land here? Don't want to miss anything.
Right. This is the place for miscellaneous business earnings that don't fit neatly elsewhere in Part 1. It's kind of a repository for odds and ends.
Like what kind of odds and ends?
Examples include things like finance reserve income, maybe income from scrap sales, bad debts you recovered that you previously deducted as worthless.
Oh, so if you wrote off a debt, but then they surprisingly paid you later.
Exactly. That recovery goes on line 6. Also, interest earned on business notes or accounts receivable, state gasoline or fuel tax refunds you received, certain federal fuel tax credits claimed on your return, prizes or awards related to your business.
Like winning a business plan competition.
Potentially, yes. Also amounts from Form 1099-P ATR, which are patronage dividends, usually from cooperatives. And what's particularly fascinating here, and a point to be really mindful of,
Uh-oh, sounds important.
it can be, if the business use of any listed property, remember, that's things like cars under 6,000 pounds, certain computers, photographic equipment, etc., drops to 50% or less during 2024, you might have to report a recapture of excess depreciation on this line 6.
Recapture, meaning I have to give back some depreciation deductions I took before.
Essentially, yes. If you previously used accelerated depreciation methods, like Section 179 or bonus depreciation, based on having more than 50% business use, and then your use drops to 50% or below, the IRS makes you calculate how much extra depreciation you took compared to the slower straight-line method. That difference gets added back to your income here on line 6.
Ouch. So track that business use percentage carefully if you have listed property.
Absolutely. It can be an unexpected income hit if your usage pattern changes significantly.
Good to know. Okay, that covers income. Now let's get to the part everyone loves, the heart of tax savings. Part 2, expenses, lines 8 through 30. This is where astute record keeping and understanding the rules really pays off.
It certainly is. This is where you actively reduce your taxable income. But before we dive into the specific expense lines, let's talk about a really foundational principle that impacts many of these deductions. The difference between capitalizing versus deducting costs immediately.
Right, expense it now or spread it out over time.
Exactly. Generally, costs you incur to produce or acquire property, like inventory you plan to sell, or real estate, or tangible personal property like machinery, must be capitalized under the Uniform Capitalization Rules, or UNICAP.
Capitalized means?
It means you add the cost to the basis of the asset. So instead of deducting the cost immediately, it becomes part of the asset's cost, and that cost is then recovered over time, usually through depreciation for assets, or as part of the cost of goods sold when inventory is sold. This delays the full tax benefit.
Okay, so capitalization generally delays the deduction. But wasn't there a big exception for small businesses here, too?
Yes, and this is another major simplification and significant cash flow benefit for many. If you qualify as a small business taxpayer, again, that generally means average annual gross receipts of $30 million or less for the 3 prior tax years. You are not required to apply these complex UNICAP rules to capitalize certain costs related to inventory or property produced for resale.
So small businesses can often just expense costs related to inventory faster.
In many cases, yes. You might be able to treat inventoriable items as non-incidental materials and supplies, which generally allows you to deduct their cost in the year they are first used or consumed in your business. Or you might be able to simply conform to the method you use for your financial accounting if you expense them there. This allows for significantly faster deductions compared to capitalizing them into inventory and waiting until the inventory is sold.
That sounds way simpler and better for cash flow.
It really is. It greatly reduces the compliance burden of tracking all those capitalized costs and allows for quicker deductions. There's also an important exception for freelance artists, authors, and photographers related to the qualified creative expenses for property they created. They may be exempt from capitalization rules for those specific creations, allowing them to deduct many costs as they are incurred.
Good exceptions to know. Okay, let's hit the specific lines. Line 9, car and truck expenses. This is a big one for so many businesses. You've got that key decision. Standard mileage rate or actual expenses. How should people approach this choice?
Right, this choice between standard mileage and actual expenses can significantly impact your total deduction. And the best method really depends on your specific situation, the type of vehicle, how much you drive, how good your records are.
Let's talk standard mileage first. Remind us of the 2024 rate.
For 2024, the standard mileage rate is 67 cents per business mile driven.
67 cents. And the appeal is simplicity, right?
Huge appeal and simplicity. It's often called the easy button for vehicle deductions. You simply multiply your documented business miles by that 67-cent rate. Then you can also add any business-related parking fees and tolls on top of the mileage calculation.
So mileage plus parking and tolls.
Correct. The big plus is you don't need to meticulously track every single receipt for gas, oil changes, repairs, insurance, registration fees, etc., because those costs are theoretically built into the standard rate.
Who can use the standard rate? Any restrictions?
Generally, you can use it if you own the vehicle and you use the standard mileage rate in the first year you place that vehicle in service for your business. Or if you lease the vehicle, you can use the standard rate, but you generally have to use it for the entire lease period.
Okay. And the crucial point, if you use standard mileage, what can't you deduct separately?
Right. If you choose the standard mileage rate, you cannot also deduct depreciation on the vehicle, or any rent or lease payments, or the actual operating expenses like gas and repairs separately. Those are considered included in the 67 cents per mile. You're choosing simplicity over itemizing every single vehicle cost.
Okay, so when would someone choose actual expenses instead?
You might choose actual expenses if, well, your actual costs are higher than what the standard rate gives you. This could happen with maybe a less fuel-efficient vehicle, or if you have high insurance or repair costs. If you opt for actual expenses, you'll deduct the business use percentage of costs like gasoline, oil, repairs, insurance, registration, tires, etc., directly on line 9.
And depreciation or lease payments.
Depreciation for vehicle you own goes on line 13, depreciation, using Form 4562. And lease payments for a leased vehicle go on line 20A, rent or lease.
Is anyone required to use actual expenses?
Yes. You are required to use actual expenses if you operate 5 or more vehicles simultaneously in your business, like a delivery fleet. Also a key restriction. Once you choose actual expenses for a leased vehicle, you generally cannot switch back to the standard mileage rate for that same leased vehicle in a later year. You're locked in.
Good to know. And regardless of method, records.
Absolutely non-negotiable. Crucial record keeping is essential no matter which method you use. You must provide detailed information on your vehicle's use, total miles driven, business miles, commuting miles, dates, purpose either in Part 4 of Schedule C or potentially on Form 4562. Otherwise, the IRS could disallow your entire deduction.
So maintain that mileage log, whether it's a notebook or an app.
Exactly. A contemporaneous log is best practice. Clearly, differentiate personal versus business miles. Note the purpose of each business trip. This is where attention to detail really pays off if the IRS ever asks questions.
Sound advice. Okay, line 10 is for commissions and fees. Seems straightforward.
Generally, yes. But there's a nuance. Payments you make to facilitate the sale of property are usually capitalized, meaning they become part of the property's cost basis, not deducted immediately.
Ah, but what if selling property is your business?
Exactly. If you are a dealer in property, meaning you regularly sell property in the ordinary course of your business, like a car dealer, a real estate broker, or maybe someone flipping houses, you can deduct those commissions and fees directly on line 10 as a current business expense.
Okay, so dealers deduct, others might capitalize, and remember 1099s if you're paying these commissions.
Absolutely. If you're the payer, remember to issue Form 1099 NEC for commissions and fees of $600 or more paid to non-employees during the year.
Got it. Line 11 is contract labor, payments to independent contractors. Very common now.
Very common. This is a clear deduction for payments you made to independent contractors for services they performed for your business. It's absolutely crucial, though, to distinguish this from employee salaries or wages. Those go down on line 26.
The classification matters, right? Contractor versus employee.
Immensely. Misclassifying an employee as an independent contractor can lead to significant back taxes, penalties, and interest related to payroll taxes. So ensure you're correctly classifying workers based on the IRS control factors.
And 1099 NECs again.
Yes, mandatory Form 1099 NDC for payments of $600 or more made to these independent contractors within the calendar year. Don't forget that compliance piece.
Okay. Line 13, depreciation and Section 179 expense deduction. You said earlier this is where it gets really interesting for tax savings, especially when buying significant business assets.
It absolutely is. This can be a huge immediate deduction if used strategically. Let's break it down. Depreciation generally is the annual deduction you take to recover the cost of business property over its expected useful life.
Property-like.
Things like machinery, equipment, computers, furniture, buildings, but not the land under them, certain vehicles, even improvements you make to lease business property. Land itself and inventory are generally not depreciable.
Okay, so depreciation spreads the cost out, but Section 179 speeds it up.
Massively speeds it up. The Section 179 election is where the real acceleration power comes in. Subject to certain limits, you can elect to expense, meaning deduct all in 1 year, part or all of the cost of certain qualifying property that you purchased and placed in service in your business during 2024.
Instead of depreciating it over, say, 5 or 7 years?
Exactly. It provides an immediate, significant deduction instead of spreading it out. This can drastically lower your taxable income in the year you make the purchase. For example, if you buy a $20,000 piece of qualifying equipment, instead of maybe deducting $4,000 a year for 5 years under standard depreciation, Section 179 might let you deduct the full $20,000 immediately in 2024.
That's a huge difference to your tax bill that year.
It really can be. It improves cash flow by reducing your immediate tax liability. There are limits, of course, a dollar limit on the total amount you can expense, $1,220,000 for 2024, and an investment limit, $3,050,000 for 2024. But for most small businesses, these limits are quite high. The deduction also can't exceed your business taxable income.
Okay. And what about that bonus depreciation we mentioned earlier? How does that relate?
Good question. Bonus depreciation is another form of accelerated depreciation. For 2024, it's 60%. It applies automatically to qualifying property unless you elect out. Section 179 is an election you make. Often you might use Section 179 first, up to its limit, and then bonus depreciation might apply to the remaining cost of qualifying assets. They can work together.
Got it. When do you absolutely need to file Form 4562 for depreciation or Section 179?
You always need to file Form 4562 if you're claiming any depreciation on property placed in service during 2024. You also need it if you're claiming depreciation on any listed property, regardless of when you acquired it. And of course, you need Form 4562 if you're making that Section 179 expense election.
Remind us what listed property includes, again, cars.
Yes, listed property includes passenger automobiles weighing 6,000 pounds or less, other property used for transportation, like motorcycles, pickup trucks with beds shorter than 6 feet, computers and peripheral equipment, unless used exclusively at a regular business establishment, and property generally used for entertainment, recreation, or amusement, like photographic or video equipment.
And why does the IRS list this property?
Because these types of property have a higher potential for personal use mixed with business use. So special rules and often stricter record-keeping requirements apply, along with potentially lower depreciation limits, especially for luxury cars. Be mindful of those extra rules if you acquire listed property.
Definitely. Okay, line 14 covers employee benefit programs. This is about deductions for benefits you provide to your team, right, Nate?
Exactly. This line is for deducting contributions you make for your employees, not for yourself as the owner. This includes things like payments for employee accident and health plans, contributions to Archer MSAs or health savings accounts, HSAs for employees, premiums for qualified group term life insurance covering employees, or costs for dependent care assistance programs benefiting employees.
Okay, benefits for the team. What about the owner's health insurance? The self-employed person's premiums?
Vital distinction here for self-employed individuals. You cannot deduct your own self-employed health insurance premiums on this line. Line 14 of Schedule C.
Where does it go then? It's deductible somewhere, right?
Yes, usually. You may be able to deduct your self-employed health insurance premiums for yourself, your spouse, and dependents on Schedule 1, Form 1040, line 17. This is an above-the-line deduction.
Meaning it reduces your adjusted gross income, AGI.
Correct. It's a separate and often very valuable tax leg that reduces your AGI, and you can generally take it even if you don't itemize deductions on Schedule A. There are rules, like it can't exceed your net profit from self-employment, but it's a key deduction found elsewhere on your 1040.
Good clarification. Don't put owner health insurance on Schedule C.
Right. Also, if you happen to claim the small employer health insurance premiums credit on Form 8941, you need to reduce your deduction for premiums here on line 14 by the amount of that credit. No double dipping.
Makes sense. Okay, line 15 is for insurance, other than health. What goes here?
This is where you deduct premiums for various other types of business insurance, things like general liability insurance, professional liability or malpractice insurance, fire, theft, flood insurance on business property, commercial auto insurance for business vehicles, if using actual expenses, business interruption insurance, cyber liability insurance, basically ordinary and necessary insurance to protect your business operations and assets.
What doesn't go here?
You cannot deduct amounts you set aside in reserve for self-insurance. That's not considered a true insurance payment. Also, premiums you pay for policies that would replace your lost earnings if you become sick or disabled are generally considered personal expenses and not deductible here.
Okay. Line 16A and 16B deal with interest expense. You mentioned earlier this can get complicated with allocation rules and potential limitations.
It can, yes. So attention to detail is important. First, you must allocate your interest expense based on how the loan proceeds were actually used.
How does that work on the form? Line 16A versus 16B.
Line 16A is specifically for mortgage interest paid on real property your business used, but only if you paid it to banks or other financial institutions for which you received a Form 1098 mortgage interest statement. All other business interest expense goes on line 16B.
Other interests like
interest on business loans not secured by real estate, interest on business lines of credit, or interest paid on business credit cards. You need to trace where the borrowed funds went, business use, personal use, investment use, and only deduct the business portion here.
Okay, allocation is key. Now, what about that limitation you mentioned, the business interest expense limitation?
Right. This raises an important question for some businesses. Is your total business interest deduction limited? If you are not considered a small business taxpayer, again, generally meaning your average annual gross receipts are over that $30 million threshold, or if you don't meet other specific exceptions, like being and electing real property trade or business,
Then what?
then you generally must file Form 8990, Limitation on Business Interest Expense under Section 163J, to calculate how much of your business interest expense you can actually deduct this year. The limitation is generally based on 30% of your adjusted taxable income plus business interest income.
What happens to the interest I can't deduct because of the limit? Does it disappear?
No. Thankfully, it doesn't just disappear. Any disallowed business interest expense carries forward indefinitely to the next tax year, where it can potentially be deducted subject to that year's limitation. It's important for multi-year tax planning if you're subject to this rule.
But the good news is,
most true small businesses fall under that $30 million gross receipts threshold and are therefore generally exempt from this complex interest limitation. That's another significant simplification benefit for small taxpayers.
okay, that's a relief for many. Line 17, legal and professional services. Fees for accountants, lawyers.
Yes, pretty straightforward. You deduct fees paid to accountants and attorneys that are ordinary and necessary expenses directly related to operating your business.
What does that include?
It includes fees for things like general legal advice for the business, drafting contracts, resolving business disputes, fees for bookkeeping or accounting services, and, importantly, fees for tax advice specifically related to your business and for the preparation of the business portion of your tax return, like Schedule C itself.
Oh.
It even includes expenses incurred in resolving asserted tax deficiencies specifically related to your business activity.
So paying your tax pro for Schedule C prep is deductible here.
Yes, the portion related to the business is. It's a vital part of professionalizing your operations and ensuring compliance.
Okay. Line 18 is office expense. Sounds simple.
It generally is.
Mm.
This is where you deduct the cost of your general office supplies, things like paper, pens, staples, folders, printer ink, and postage used in your business. Keep those receipts from the office supply store.
Will do. Line 19, pension and profit sharing plans. We talked about owner contributions going elsewhere, so this is only
That's
for
only for contributions you made for your employees to qualified retirement plans.
like a simple IRA for employees or a 401k plan if you have one.
Exactly. This line is specifically for deductible contributions made on behalf of your employees to plans like SEP IRAs, simple IRAs, qualified pension or profit-sharing plans, including 401ks.
And just to hammer it home, your own contributions as the self-employed owner.
Your own contributions made on your behalf as a self-employed person, contributions to your own SEP IRA, your own simple IRA, or your own solo 401k are deducted elsewhere, typically on Schedule 1, Form 1040, line 16, not here on Schedule C.
Got it. Common mistake, you said.
Very common. Mixing those up can lead to miscalculations. Also remember that if you do have these types of plans, even a one-participant solo 401k, you usually have annual filing requirements for the plan itself, like filing Form 5500EZ or Form 5500SF.
Good reminder on the compliance side.
Yeah.
Okay, lines 20A and 20B are for rent or lease payments. What's the difference?
Line 20A is specifically for the business portion of rent or lease payments for vehicles, machinery, and equipment. So if you lease a car for business, and are using the actual expense method, or lease a copier or rent specific machinery, that goes on 20A.
Okay, and 20B.
Line 20B is for rent paid for other business property. The most common example is renting your office space in a commercial building separate from your home. It could also be rent for warehouse space or land you lease specifically for business operations.
You mentioned something about an inclusion amount for leased vehicles.
Yes. If you lease a passenger automobile for a term of 30 days or more, there's a complex rule that might require you to include a certain amount in your income, effectively reducing your lease payment deduction. This lease inclusion amount is intended to partially offset the deferral advantage of leasing compared to the depreciation limits on purchasing luxury cars. You find the amount in IRS tables based on the car's value and the lease year. It's complicated, but important if you lease pricier vehicles.
Good to be aware of. Line 21, repairs and maintenance. What's the key distinction here again? What's deductible now versus what has to be capitalized?
The key is distinguishing between deductible repairs, which keep property in good working order, and capitalized improvements, which make the property better, restore it, or adapt it to a new use.
So fixing a leaky faucet is a repair.
Likely, yes. You deduct incidental repairs and maintenance costs that merely maintain the property in its ordinary operating condition and don't add significant value or substantially prolong its useful life. Think routine maintenance, fixing minor damages, keeping things running smoothly. You cannot, however, deduct the value of your own labor if you do the repairs yourself.
Okay. And improvements, like replacing the whole roof.
Replacing a whole roof is typically considered an improvement, not a repair. Costs spent to improve property, meaning make it substantially better, restore it from disrepair, or adapt it to a new or different use, must generally be capitalized and then depreciated over the property's life. They provide a benefit over multiple years, so the deduction is spread out. This prevents taking a large, one-time deduction for something that enhances the asset's long-term value.
Repair now, improve over time. Got it. Line 22, supplies. How is this different from office expenses on line 18?
Line 18, office expense, is really just for basic office supplies and postage. Line 22, supplies, is broader. It's for the cost of other materials and supplies actually consumed or used in operating your business during the year.
Like what kind of supplies?
It depends on the business. For a cleaning service, it would be cleaning chemicals. For a contractor, maybe small tools or materials not built into specific jobs. For a restaurant, maybe napkins and straws. The general rule is you deduct the cost of supplies only when you actually use or consume them.
So if I buy a big box of supplies, I deduct it as I use them up.
Technically, yes. However, there's a practical simplification. If you have incidental supplies for which you don't keep track of inventory on hand, you could deduct the cost of those incidental supplies that you purchased during the year, provided this method clearly reflects your income over time. This avoids having to track usage for every minor item.
Okay, that's helpful for small stuff. Line 23 is for taxes and licenses. You said earlier this can be a gold mine if you know what to look for, but also confusing. What can we deduct here?
Absolutely.
Yeah.
You can deduct many types of taxes and licenses that are ordinary and necessary expenses of carrying on your trade or business. This includes state and local sales taxes that are imposed on you as the seller of goods or services if you also include the collected tax in your gross receipts on line 1. You basically wash it out, income in, deduction out.
Okay. What else?
Real estate taxes and personal property taxes paid on your business assets, like property tax on your office, building, or equipment, annual business licenses or regulatory fees paid to state or local governments to operate your business, the employer's share of Social Security and Medicare taxes you pay for your employees, federal unemployment tax, FUTA, that you pay as an employer, federal highway use tax, if applicable to your business vehicles, and contributions you make to state unemployment insurance funds or state disability funds, if they're considered taxes under state law.
That's quite a list. Now, what taxes are definitely not deductible here that people might mistakenly try to claim?
Right. Knowing what not to deduct is just as important. You absolutely cannot deduct.
Yeah.
Federal income taxes. That includes the income tax on your business profits and, importantly, your self-employment tax itself.
But wait, isn't half the self-employment tax deductible somewhere?
Yes. Crucial point. 1/2 of your calculated self-employment tax is deductible, but not here on Schedule C. It's an above-the-line deduction on Schedule 1, Form 1040, line 15. It directly reduces your adjusted gross income. Huge benefit, but claimed elsewhere.
Okay, good clarification. What else is non-deductible on Schedule C, line 23?
You also can't deduct estate or gift taxes. Taxes assessed for local improvements that tend to increase the value of your property,
Right.
like assessments for new streets, sidewalks, or sewers. Those are generally added to the basis of the property, not deducted.
Yeah.
Taxes on your personal residence or personal property, unless you have a qualifying home office deduction calculated elsewhere. State and local sales taxes on assets you purchase for your business, like sales tax on a new computer or machine, those taxes are added to the cost basis of the asset and depreciated, not deducted immediately as a tax expense here.
Ah, so sales tax on purchases gets capitalized.
Generally, yes. And finally, if sales taxes are imposed on the buyer and you as the seller merely collect and remit them to the government, those collected taxes are not included in your gross receipts, line 1, and therefore not deducted as an expense here on line 23, unless the state lets you retain a portion, which then becomes income on line 6.
Wow, okay. Taxes are definitely nuanced. You need to know which tax is which and where it goes.
Absolutely. It's a key area for potential savings, but requires careful categorization.
All right. Lines 24A and 24B cover travel and meals expenses for business on the go. Let's start with travel expenses on line 24A. What qualifies?
Line 24A is for deducting your ordinary and necessary expenses incurred while traveling away from home overnight for your business, profession, or job.
Away from home overnight. That's the key phrase.
That's the key trigger. Away from home generally means away from your tax home, which is usually your main place of business or post of duty, regardless of where your family lives. And the travel must be long enough to reasonably require sleep or rest.
So driving across town for a meeting doesn't count as travel here.
Correct. Daily commuting between your home and your regular work location is never deductible travel. However, travel expenses incurred going between your home and a temporary work location outside your metropolitan area might be deductible. Or travel between multiple work locations during the day could involve deductible transportation costs, but lodging wouldn't apply unless you're away overnight.
What kind of expenses go on line 24A?
Primarily lodging, hotels, motels, and transportation costs. Airfare, train fare, bus fare, car expenses if you drive your own car, though car expenses are often calculated on line 9 first. It also includes things like taxi fares between the airport and hotel, or hotel and work location, tips related to travel, dry cleaning, and laundry while traveling.
What about meals while traveling?
Meals are deducted separately on line 24B, subject to their own limitation rules. Line 24A is just for the travel components other than meals.
Is there any simplification for small travel costs?
Yes, for incidental expenses, only things like fees and tips given to porters, baggage carriers, hotel staff. Instead of keeping records of the actual costs, you can choose to use an optional standard allowance of $5 per day for these incidentals while traveling away from home. But this doesn't cover lodging, transportation, or meals.
Okay, $5 a day for incidentals is an option. Any restrictions on travel, like conventions?
Yes, there are restrictions, especially for conventions held outside the North American area. Deductions might be limited or disallowed unless the meeting is directly related to your business and it was as reasonable to hold it outside North America as within it. Stricter rules apply.
Good to know. Okay, now line 24B, business meal expenses. We know the general rule is 50% deductible. Remind us of the conditions.
Right, most business meals are indeed only 50% deductible. To qualify for even the 50% deduction, the meal expense must be an ordinary and necessary business expense. It can't be lavish or extravagant under the circumstances.
Okay.
And critically, either you or an employee of yours must be present when the food or beverages are furnished.
Can't just send your client out to dinner alone on your dime and deduct it.
Generally, no. You or an employee needs to be there. And the meal must be provided to a current or potential business customer, client, consultant, or similar business contact.
What if the meal is part of entertainment, like dinner before a show?
Tricky area. Entertainment expenses themselves are generally not deductible anymore. If food and beverages are provided during or at an entertainment event, they are only deductible at 50% if they are purchased separately from the entertainment, or if their cost is stated separately from the cost of the entertainment on the bill or invoice.
So you need that separate charge for the food.
Yes, you can't try to sneak non-deductible entertainment costs into the meal cost to get around the rule. The IRS is wise to that.
Okay. Can you use a standard rate for meals while traveling instead of tracking every restaurant receipt?
Yes, you can. Instead of keeping records of your actual meal costs while traveling away from home, you can choose to use the standard meal allowance, which is based on the federal M&IE, meals and incidental expenses, per diem rates for the location of your travel. You can find these rates on the GSA website, gsa.gov.
And that standard rate is still subject to the 50% limit.
Yes, the standard meal allowance amount you claim is still generally subject to the 50% limitation. And even if you use the standard allowance, you still need to keep records to prove the time, place, and business purpose of your travel. The standard rate just simplifies the amount calculation.
Got it. Now, you hinted earlier there were exceptions to the 50% rule. When can you deduct more than 50% of a meal?
Right. There are a few important situations. First, for certain individuals subject to the Department of Transportation, DOT, hours of service limits, think commercial pilots, air crew, interstate truck operators, railroad engineers, merchant mariners, the deduction for their business meals while traveling is actually increased from 50% to 80%.
It's 80% for those specific transportation workers. Okay.
And what's really interesting is that certain meals can actually be 100% deductible.
100%. Like what?
A few key examples. Meals you provide on your business premises for the convenience of the employer, if more than half the employees are furnished meals there for that reason. This is often called the de minimis fringe benefit rule. Meals that are treated as taxable compensation, wages to employees, and subject to payroll tax withholding. For instance, if you provide regular lunches at the office, and it's clearly part of their compensation package.
Okay.
Meals provided to non-employees, like independent contractors, if the cost of those meals is includable in their gross income as compensation for services, and you properly report it to them and the IRS, usually on Form 1099 NEC.
So if it's taxable income to them, it's 100% deductible for you.
Exactly. Also, expenses for recreational or social activities, primarily for the benefit of your employees who are not highly compensated, like a company picnic or holiday party. The food and beverages there are generally 100% deductible.
The office holiday party deduction lives.
It does. And finally, for certain daycare providers, they can use special standard meal and snack rates for the eligible children in their care instead of tracking actual food costs. And these amounts can be 100% deductible as a food expense.
Wow. Knowing those 80% and 100% exceptions can lead to significant extra savings for specific types of businesses or situations.
Absolutely. Don't just assume everything is 50%. Check if one of these valuable exceptions applies to you.
Great advice. Okay, line 25, it's for utilities. What goes here?
This is where you deduct the business portion of your utility costs, like electricity, gas, water, telephone, and internet service used for your business.
Only the business portion, right. How does that work if it's your home phone?
Right. For your home telephone, there's a specific rule. You generally cannot deduct the basic monthly charge, including taxes, for the first telephone line into your residence, even if you have an office in the home. That's considered a non-deductible personal expense.
Okay, no deduction for the first home phone line's base cost.
Correct. However, you can deduct any additional costs you incur specifically for business use on that first line, like long-distance business calls or optional services used only for business. And if you have a second phone line into your home used exclusively for your business, the full cost of that second line is deductible.
What about cell phones or internet?
For cell phones and internet service, you deduct the percentage of the cost that relates to your business use. If you have a dedicated business cell phone or internet line, 100% is deductible. If you use your personal cell or home internet for both business and personal use, you need to reasonably allocate the cost based on your business usage percentage. Keep records to support your allocation.
Allocation, allocation, allocation. This seems to be a theme.
It is, especially when expenses have both business and personal components.
Line 26 is for wages. This is specifically for
This is where you deduct the total gross salaries and wages you pay to your employees during the tax year.
employees, not contractors.
Correct. Contract labor goes on line 11. This line 26 is for actual W-2 employees. Your deduction here should be the gross wages before any payroll deductions for things like income tax withholding, Social Security, Medicare taxes, or employee contributions to retirement plans.
Okay, gross wages. Any reductions needed here?
Yes, you generally need to reduce your wage deduction here by the amount of certain employment-related tax credits you might claim elsewhere on your return, such as the Work Opportunity Credit, Form 5884, the Empowerment Zone Employment Credit, Form 8844, or the Credit for Employer Differential Wage Payments, Form 8932. No double benefit.
And definitely don't include payments to yourself here, right?
Absolutely crucial reminder, do not include any amounts paid to yourself as the sole proprietor or owner. Your own draws or owner's pay are not deductible wages on Schedule C. Your pay is the net profit of the business that flows through to your personal return.
Got it. You also need to file Form W-2 for each employee showing their wages and withholdings.
Yes, W-2 filing is a mandatory part of having employees.
Okay. Line 27 has two parts, 27A and 27B. 27A seems reserved. What's 27B, energy efficient commercial buildings deduction?
Right. 27A is currently reserved. Line 27B is for a specific deduction related to improving the energy efficiency of commercial buildings. You may be able to deduct part or all of the expenses incurred for installing property that's part of a plan to significantly reduce the energy costs of a new or existing commercial building.
Like installing better insulation or more efficient HVAC.
Exactly. Things like improvements to the building envelope, HVAC systems, or lighting systems that meet certain energy-saving targets. You generally need to file Form 7205 Energy Efficient Commercial Buildings Deduction to calculate and claim this. It's an incentive from the government for businesses to invest in green building improvements, most relevant for businesses that own their building.
Good to know it exists. Now, we arrive at line 30, business use of your home. You said earlier this is a major opportunity for deductions for many home-based business owners, often one of the biggest deductions available.
It truly is, especially with so many people running businesses from home these days. This deduction can be one of the most significant tax savers for a home-based entrepreneur, but it requires careful attention to the rules.
And there are two main ways to calculate it, right? Simplified versus actual.
Correct. You have two primary methods to choose from: the simplified method or the actual expense method. The actual expense method typically involves completing and attaching Form 8829, expenses for business use of your home.
Can you switch between methods each year?
Yes, you can choose whichever method gives you a better result or is easier each year for each qualified business use of a home. You make the choice annually when you file your return. However, you cannot use both methods for the same home and the same business in the same tax year.
Okay, flexibility is good. Let's do a deeper dive into the simplified method first. It sounds like the easy button, maybe.
It's definitely designed to simplify the calculation significantly, removing the need to track and allocate actual home expenses.
How does the calculation work?
It's very straightforward. You calculate your deduction by multiplying the square footage of your home used for qualified business purposes by a prescribed rate. For 2024, that rate is $5 per square foot.
$5 per square foot. Is there a limit on the square footage?
Yes, the maximum square footage you can use for the simplified method calculation is 300 square feet.
So the maximum deduction under the simplified method is $1,500 per year. 300 SQF, 5 sickle feet.
Exactly. $1,500 is the maximum deduction you can get using the simplified method.
That definitely seems simpler than tracking utility bills, mortgage interest, property taxes, repairs, etc.
It absolutely simplifies the calculation, the allocation of expenses, and the substantiation needed for actual costs. But, and this is a really crucial caveat, the simplified method does not change the underlying rules for qualifying to take the home office deduction in the first place.
Ah, so just because the calculation is simple doesn't mean qualifying is automatic.
Precisely. The space you're claiming still needs to meet the strict requirements for a home office. Generally, this means a specific area of your home must be used regularly and exclusively for your trade or business.
Regularly and exclusively, meaning no personal use of that space at all.
Generally, yes, exclusive use means only for business. There are exceptions, like if the space is used regularly for storing inventory or product samples for your business, and your home is the sole fixed location of the business, or if you run a licensed daycare facility out of your home, then it needs to be used regularly, but not necessarily exclusively. Also, the space generally needs to be your principal place of business or a place where you meet or deal with patients, clients, or customers in the normal course of your business.
So the simplified method is only about the calculation, not about qualifying for the deduction itself.
Exactly. If you don't meet those underlying regular and exclusive use tests, or the daycare storage exceptions, you can't claim the home office deduction using either method, simplified, or actual.
Okay, that's critical. Qualification first, then calculation method. How do you elect the simplified method?
You elect it simply by using it on your timely filed original tax return for that year. You perform the calculation, square footage up to 300 by $5, and put the result on Schedule C, line 30. The election is irrevocable for that specific year.
What if you share your home with someone else who also runs a business from home? Can you both use the simplified method?
Yes, if you both qualify. If you share a home, like roommates or even spouses filing separately, and both of you use different portions of the home for separate qualifying businesses, each of you can make your own election simplified or actual. However, you cannot claim the same square footage. Any shared space used by both businesses must be reasonably allocated between you.
Okay. What if you only use the home for business for part of the year? Say, you started the business mid-year or you moved.
Good question. If you use the home for qualified business purposes for only part of the year, or if the square footage of your business space changed during the year, you cannot use the full square footage for the whole year. You must calculate an average monthly allowable square footage.
Average monthly allowable square footage. How does that work?
You figure the allowable square footage up to the 300 desk square app limit for the simplified method. For each month, you had qualified use for at least 15 days. Then you add up those monthly amounts and divide by 12 to get the average for the year. That average square footage is what you multiply by $5.
Okay, so it prorates the space based on months of use. The instructions likely have examples.
Yes, the instructions provide detailed examples like Finley, Riley, and Carter scenarios, showing how to calculate this average monthly allowable square footage if you start, stop, or change your home office use mid-year.
Got it. Now, a really important point for the simplified method. What happens with depreciation on the home itself? Can you still depreciate the business portion of your home if you use the simplified method?
This is another critical aspect and a potential drawback of the simplified method. If you use it, you cannot deduct any depreciation or a Section 179 expense for the business use portion of the home itself for that year. The depreciation deduction for that part of the home is deemed to be zero.
So no depreciation deduction on the house structure when using simplified. That could be a significant difference compared to the actual method over time.
It absolutely can be, especially as home values increase. However, and this is key, you can still deduct depreciation or the Section 179 expense on other assets used in your home business.
Like what?
Like your business furniture, desk, chair, computers, printers, specialized equipment that you own and use within that home office space. Those assets are still separately depreciable using Form 4562, even if you use the simplified method for the home space itself.
Okay, so depreciation on the home structure is out, but depreciation on business assets in the home is still okay.
Correct. Another limitation. The home office deduction calculated using the simplified method still cannot exceed the gross income derived from the qualified business use of the home minus the business deductions unrelated to the use of the home, like advertising or supplies.
So the deduction can't create or increase a business loss.
Right. And importantly, any amount of simplified method home office expense that's disallowed due to this income limitation cannot be carried over to the next tax year. It's just lost for that year.
That's different from the actual expense method, isn't it? Don't disallowed actual expenses carry over.
Yes, that's a key difference. If you use the actual expense method, Form 8829, any disallowed amount due to the income limit can be carried over to the next year.
Okay, so that's a potential advantage of the actual method if you expect losses or low income. What if you used the actual method last year, had a carryover, and now want to use the simplified method this year? Is that carryover lost?
No, thankfully it's not lost. This is good news for flexibility. If you have unallowed actual home office expenses from a prior year, which would have been carried over on Form 8829, that carryover amount is preserved. You carry it forward to the next tax year that you choose to use the actual expense method again. It doesn't disappear just because you use the simplified method in the intervening years.
That's great. So you don't get penalized for switching to simplified for a year or two. How do you report the simplified method deduction?
If you're using the simplified method, you'll calculate the amount using the simplified method worksheet found in the instructions or in your tax software. You then enter the resulting deduction amount directly on Schedule C, line 30. You do not file Form 8829 if you use the simplified method.
And if using actual expenses?
If you're checking actual expenses, you generally must complete and attach Form 8829, expenses for business use of your home. The result from Form 8829 then flows to Schedule C, line 30.
Okay, simplified seems much easier calculation-wise, but has trade-offs like no home depreciation and no carryover of disallowed expenses. Actual is more complex, but might yield a larger deduction and allows carryovers.
That's a perfect summary of the key differences. You need to weigh the simplicity against the potential tax benefit each year.
That covers the main expense lines up to the home office. Now we get to the bottom part of Schedule C. Lines 31 and 32 deal with the net profit or loss and potential limitations.
Exactly. Line 31 is your net profit or loss. This is your bottom line for the business activity reported on this Schedule C. You calculate it by subtracting your total expenses, line 28, from your gross income, line 7. If line 7 is more than line 28, you have a net profit. If line 28 is more than line 7, you have a net loss.
And that net profit or loss number flows where?
That net profit or loss generally flows to Schedule 1, Form 1040, line 3. From there, it gets combined with your other income or losses to calculate your overall adjusted gross income on your Form 1040.
What about self-employment tax?
If you have a net profit on line 31 and it's $400 or more, that amount generally also flows to Schedule SE, line 2, which is used to calculate your self-employment tax, Social Security and Medicare taxes.
Okay. Are there exceptions to that?
Yes, a couple of key ones. Remember those statutory employees? Their income from Schedule C, line 31 does not go to Schedule SE because SE taxes were already handled via their W-2. Also, income earned as a notary public from notary services is generally not subject to self-employment tax, so that wouldn't go to Schedule SE either.
Good exceptions. Can the net profit also help with credits?
Yes, potentially. Your net profit from self-employment reporting here is considered earned income, which might help you qualify for or increase the amount of the Earned Income Credit, EIC, especially if your overall income is within the EIC limits.
Okay. Now, what if line 31 shows a loss? Are there potential limitations on deducting that loss? You mentioned passive losses earlier and excess business losses. Anything else?
Yes, if you have a loss on line 31, it might be subject to several potential limitations that could reduce the amount you can actually deduct this year. We already discussed the passive activity loss rules, Form 8582, which apply if you didn't materially participate. Line G was no. And we talked about the excess business loss limitation, Form 461, for very large losses. The other major hurdle is the at-risk rules.
At-risk rules. Okay, what's that about? Line 32 asks about this.
Line 32 asks if all of your investment in this business is at risk. The purpose of the at-risk rules is generally to limit the amount of loss you can claim to the amount you personally stand to lose financially in the business.
So you can't deduct losses funded by money you aren't actually responsible for repaying.
Essentially, yes. You are generally considered at risk for amounts like the money and the adjusted basis of property you contributed to the business, amounts you borrowed for use in the business if you are personally liable for repayment, or if you pledged property not used in the business as security for the loan.
What kind of financing would not be considered at risk?
You are generally not considered at risk for non-recourse loans. These are loans where the lender can only take the property securing the loan, like business equipment, if you default, but they can't come after your personal assets. Unless the non-recourse loan is secured by your personal property or meets specific rules for qualified non-recourse financing related to real estate, amounts for which you are protected against loss by guarantees, stop-loss agreements, or similar arrangements. Loans from someone who has an interest in the business, other than as a creditor or someone related to such a person.
Okay, so if I have financing where I'm not personally on the hook, I might not be fully at risk.
Correct. If you have amounts invested in the business for which you are not at risk, you must check the No box on line 32B, and you generally must complete and attach Form 6198, At-Risk Limitations, to figure out how much of your loss is actually deductible.
And what happens to the loss disallowed by the at-risk rules? Gone forever.
No, similar to passive losses, any loss disallowed because of the at-risk rules is generally treated as a deduction allocable to that same business activity in the next tax year. It carries forward until you have sufficient at-risk basis to absorb it.
So, multiple layers of potential loss limitations. At risk, passive activity, and excess business loss. You need to navigate all of them if you have a loss.
Exactly. They are applied in that order. At risk first, then passive activity, then excess business loss. It's crucial to check these if line 31 shows a loss, as they can significantly impact your currently deductible amount.
Makes sense. Okay, let's briefly touch on part 3. Cost of goods sold. This is mainly relevant if you sell merchandise, right?
Correct. Part 3 is where you calculate your cost of goods sold, COGS. This calculation is necessary if the production, purchase, or sale of merchandise is an income-producing factor in your business. Think retail, wholesale, manufacturing.
And the basic formula is beginning inventory plus purchases ending inventory equals COGS.
That's the core idea, yes. Although the form breaks it down a bit more with lines for labor, materials, supplies, and other costs.
Yeah.
The resulting COGS figure from line 42 is then entered on line 4 of part 1 and subtracted from your net receipts to arrive at your gross profit on line 5.
Now, we keep mentioning that small business taxpayer exception, $30 gross receipts. Does that impact inventory and COGS too?
Yes, significantly. This is another major simplification and potential tax-saving mechanism related to that exception. If you meet the $30 million average annual gross receipts test and aren't a tax shelter, you can choose not to keep an inventory for tax purposes.
Choose not to keep inventory. How does that work if you sell products?
Instead of using inventory accounting, you can choose to treat your inventoriable items in one of two ways. One, as non-incidental materials and supplies. This generally means you deduct their cost in the year they are first used or consumed in your operations. Two, or you can choose to conform to the inventory method you use in your financial accounting records, like your books prepared according to GAAP or another basis. If your accounting method treats inventory costs as an expense when incurred or paid, you can potentially deduct them faster for tax purposes too.
So this avoids the complexity of tracking beginning-ending inventory values and complex costing methods like FIFO or LIFO.
Exactly. It significantly reduces the compliance burden and can often accelerate the deduction of costs associated with acquiring or producing the items you sell, improving cash flow. It's a huge practical benefit for qualifying small businesses that deal with merchandise.
Great simplification. Part 4 is information on your vehicle. This ties back to line 9, car and truck expenses, right?
Correct. If you claim any car or truck expenses on line 9, you generally need to provide the information requested in Part 4. This includes things like when you place the vehicle in service for business, the total miles driven during the year, the miles driven for business, commuting miles, and personal miles. It also asks if you have evidence to support your deduction and if it's written.
This is where that mileage log comes in handy again.
Absolutely essential.
Yeah.
This section emphasizes the strict record-keeping requirements. It clarifies again that commuting miles between home and your regular place of work are not deductible business miles. However, travel to temporary work locations or travel from a home office that qualifies as your principal place of business can be deductible business travel. You need records to prove it. The IRS publication Pub 463, Travel, Gift, and Car Expenses, has all the nitty-gritty details on record keeping.
Okay, keep those records. Finally, we get to Part V, other expenses, line 48. You called this the miscellaneous deduction goldmine earlier. It's the catch-all for everything else.
It is indeed the catch-all. Line 48 is where you list and deduct all your other ordinary and necessary business expenses that weren't specifically deducted on lines 8 through 30. You list the type of expense and the amount.
What kind of things typically end up here?
All sorts of miscellaneous items. Bank service charges for your business account, professional dues or subscriptions related to your business field, business publications, maybe advertising costs not large enough to warrant their own line. Minor repairs not included on line 21, business-related education that maintains or improves skills required in your current business.
But beyond the miscellaneous, you mentioned some specific, powerful, often overlooked deductions that land here. Let's recap those tax-saving opportunities within other expenses.
Yes, absolutely. This is where some real gems can be found. Amortization. While depreciation line 13 is for tangible assets, amortization is for certain intangible assets or specific capitalized costs that you deduct over a set period. This includes costs like acquiring goodwill, trademarks, patents, copyrights, certain research and experimentation costs, the rules changed recently, or costs of pollution control facilities. These are valuable deductions spread over time, usually calculated on Form 4562, and then the annual amount is listed here. Bad debts. If you use the accrual method and included an amount in income from a sale or service, and that debt later becomes totally worthless and uncollectible, you can deduct that bad debt here. Cash method taxpayers generally can't deduct bad debts because they never included the amount in income. Business startup costs. This is a significant initial boost we mentioned. For costs incurred before your business actively begins operations, you can elect to deduct up to $5,000 of business startup costs, and up to $5,000 of organizational costs, if forming a partnership or corporation, less common for Schedule C, in the year the business begins.
$5,000 startup plus $5,000 organizational. That's potentially $10,000 upfront.
Potentially, yes. This $5,000 limit for each category is reduced dollar for dollar if your total costs in that category exceed $50,000. Any remaining costs above the $5,000 immediate deduction are then amortized, deducted ratably, over a 180-month period, starting with the month the business begins. This is a crucial early-stage tax advantage to recover initial setup expenses faster.
Great for new businesses. What else?
Deduction for removing barriers to individuals with disabilities and the elderly. This is a very specific but impactful deduction. You can elect to deduct up to $15,000 per year of qualifying costs paid or incurred in 2024 to remove architectural or transportation barriers in your business facilities or vehicles, making them more accessible. This is a direct tax incentive for businesses to improve accessibility. Non-taxable Medicaid waiver payments. We've hit this a few times, but it's critical. This is where the expense portion goes. If you receive these excludable payments, reported on line 1, you list the non-taxable amount here as an expense, noting Notice 2014-7 next to it to complete the exclusion process.
Okay. Keep going. This is good stuff.
De minimis safe harbor election for tangible property. This is a fantastic simplification and practical saver for almost every small business. Instead of capitalizing and depreciating smaller asset purchases, you can elect to deduct them immediately if they meet certain criteria.
Like buying a new printer or maybe a desk.
Exactly. If you have what's called an applicable financial statement, AFS, usually meaning audited financial statements, which most small businesses don't have, you can elect to expense items costing up to $5,000 per item or per invoice.
And if you don't have an AFS, which is most small businesses.
If you don't have an AFS, you can still elect to expense items costing up to $2,500 per item or per invoice. To use this safe harbor, you must also have a policy at the beginning of the year to expense these amounts for your books and records.
$2,500 per item is still really useful. That covers most laptops, printers, furniture pieces.
Absolutely. This allows for immediate deduction of many smaller asset purchases, greatly simplifying record keeping, no need to track depreciation for these items, and improving cash flow significantly. It's a huge time saver and cash flow accelerator. You make this selection annually by attaching a statement to your return.
Fantastic tip. Anything else major in Part V?
Forestation and reforestation costs. This is specific but valuable for those with timber property. You can elect to expense up to $10,000 per year, $5,000 if married filing separately, of qualifying costs paid or incurred in 2024 for forestation or reforestation projects like site preparation or planting trees. Any remaining qualifying costs can then be amortized over an 84-month period.
Okay, good for timber businesses. So Part V is definitely worth scrutinizing for these less common but potentially valuable deductions.
Absolutely. Don't just dump miscellaneous receipts here.
Yeah.
Look for these specific opportunities within the other expenses category.
Now finally, something that isn't on Schedule C itself but is directly impacted by your Schedule C results, and you mentioned it earlier, the Qualified Business Income, or QBI deduction. Why is this so important to mention in a Schedule C discussion?
Because it's truly an overarching benefit and one of the biggest tax breaks currently available for many self-employed individuals and small business owners.
Yeah.
Your net profit calculated on Schedule C, line 31, is often considered qualified business income, QBI.
And having QBI can lead to?
Having QBI can potentially entitle you to a significant deduction, generally up to 20% of that QBI, subject to various limitations based on your overall taxable income and potentially W-2 wage asset basis. on your personal Form 1040 or 1040-SR, specifically on line 13.
So the profit you show on Schedule C directly feeds into calculating this potentially large deduction on your personal return.
Exactly. While you don't calculate the QBI deduction on Schedule C itself, you use Form 8995 or A995A, the result from your Schedule C is the starting point. Understanding how your Schedule C net profit can lead to this further saving is absolutely essential for maximizing your overall tax efficiency as a sole proprietor, partner, or S-Corp owner. It's a powerful incentive tied directly to your business success reported on Schedule C.
Fantastic connection to the bigger picture. Okay, let's try to unpack all of this and bring it together. What we've explored today really shows that preparing your Schedule C isn't just, about reporting income and expenses like a chore. It's genuinely a strategic opportunity to optimize your tax position and keep more of your hard-earned money.
Absolutely. From making smart choices, like between the standard mileage rate and actual vehicle expenses based on your specific situation.
Or strategically leveraging the Section 179 deduction for those big equipment purchases to immediately slash your taxable income.
Or simplifying your life and deductions with the Home Office Simplified method while understanding its trade-offs.
Right. Each line item, each choice really offers a chance for a smart financial move. We've even uncovered those specific, often overlooked deductions hiding in Part V, like for startup costs or removing accessibility barriers, or that incredibly practical de minimis safe harbor for expensing smaller asset purchases.
And if we connect this to the bigger picture, it means that being meticulously informed about these Schedule C instructions transforms what might seem like a daunting, purely compliance-driven task into a genuinely empowering exercise for a business owner.
It really does. It's about taking control of your financial destiny, making sure you're not leaving money on the table with the IRS, and maximizing every single opportunity the tax code legally allows.
It's about playing offense with your taxes, not just defense.
I like that, playing offense. So what does this all mean for you, our listener? As you prepare to compile your tax information, maybe you're getting ready for year-end planning or starting to gather documents for tax season, remember that knowledge truly is power, especially when it comes to your business's bottom line.
The details we've covered today aren't just boring compliance requirements. They are pathways. Pathways to significant tax savings, improved cash flow, and ultimately a healthier financial future for your business.
Which raises, I think, an important question for you to consider. How will you use this deep dive into Schedule C to transform your tax filing from just a necessary chore into a real strategic advantage for your business this year?
Take these insights, go back, maybe revisit your records from this past year, or plan better for the next. Discover the true potential hiding within your Schedule C.
It's worth the effort. Thanks for joining us on the deep dive.